Well, good morning, everyone, and thank you very much for coming. I want to defend the banking system that we have. That's going to be my main point. Today is going to be quite interesting because it's actually last night and breakfast today. I've just had a blinding insight, which I'll explain at the end of my talk. But anyway, we'll come on to that. What I want to do is we have a world where you see in nation after nation a certain pattern of banking. You see a central bank which is usually publicly owned and has a monopoly of the issuance of legal tender. And this gives it the power to conduct monetary policy. And then as a commercially owned banking system that carries out payment services for most non-banks, households, companies, and so on. And this banking system provides the payment services apparently for free, but they aren't really free because, in fact, they're made possible by the profits on the asset side of the bank's balance sheet, which arise from loan books and holdings of securities. And what you see these commercial banking systems is that everywhere they are, on the face of it, extraordinarily risky. They are both highly leveraged, their assets are a very high multiple of their capital, and they're also fractionally reserved in the sense that the legal tender cash that they hold, and which they must repay to depositors, and which they use to settle obligations with other payments to other banks, you see that the cash is only a tiny fraction of their assets. So these organizations are extremely risky in respect of both sides of their balance sheets. You know, I think when I was doing my investment exams to become a member of the London Stock Exchange back in the 1970s, a trick question was to compare the balance sheet of a very highly geared property company with the balance sheet numbers for NatWest Bank, which we've got a model of. And of course, NatWest numbers in terms of the gearing and the rest of it were completely off the wall compared with this property company that went bust in the next 2 or 3 years. But that was because of the nature. Now, so what you then have, and I'll go through you then have is when many people come to this industry from not knowing much about it, they say, this is a horror. You know, of course there are banking crises. There's too much leverage, and they're vulnerable to a run. Therefore, what we should do is tighten up regulation. There must be ever more capital relative to banks' assets and the risks they've got. They should have ever more liquidity relative to their loan book so they're not vulnerable to a run. And ladies and gentlemen, that's what's going on at the moment. You've got one or two people from the investment world here. The banking system is not valued today at a fraction of what it was worth on the world stock markets in 2006. And can I also just say that the banking system essentially is friendless? I'm simplifying. But perhaps my most important point is that free market economists are among the critics of this system. And in my view, what's happening in the general attack on the banking system is very unhealthy for market capitalism and is part of, in the background, part of the trouble of what's going on at the moment. Okay, well that's kind of, the blinding insight was this, yesterday and this morning, to see how this interacts with the proposal for central bank digital currency, which I'll come on to at the end. Okay, well, I'll just go through my slides, but that's the guts of what I have to say. And you will gather that I'm basically a defender of the banking system and a defender of these ostensibly extremely risky organizations. The banks, I explained this in the first couple of lectures in my MSc course. Banks have always been very controversial. But in fact, the payment of interest has always been controversial. This goes back to Plato and Aristotle. It's obviously very important in some religions. The beginning of banking, Middle Ages, is this realization that a goldsmith starts to issue note receipts for the gold deposited with him or her, and then the notes start to be used in payments, they become acceptable in a certain circle, and the goldsmith becomes a banker because he realizes that he can make loans, not just in gold, but in these notes. So the notes go out, initially they pay no interest, the loans do pay interest. What a fabulous business to be in. Let's grow this note issue, etc., etc. Eureka, essentially the money is being created out of thin air. And this is right back at the beginning. This was known about, in the 16th, 17th centuries, and was already then very controversial, even then. Now, here we have this is Mervyn King, who, by the way, has been extraordinarily kind to the Institute and was at our annual lecture on Monday. He is one of the critics of this system. He wrote a book which came out in 2016 called The End of Alchemy, which effectively wanted an end to this business of the banks being able to create money out of thin air by adding identical sums to both sides of their balance sheets. It's not at all a maverick position, and people like even Milton Friedman were sympathetic to this kind of thing. So the question raised by this question I've just been presenting to you, does society benefit from these ostensibly very risky organizations? I think they do, and I'm going to explain in the next few minutes how. By the way, the second speaker is going to defend the system I'm about to criticize, so we have a proper discussion and debate, I hope. And let's just be clear that we have these people who say that the banks shouldn't be able to create money out of thin air, that they shouldn't be able to have their assets, only a tiny fraction being cash, that should be 100% cash for safety. So these things are imposed upon them from outside by the state. The banks must not be free to choose their cash and capital positions, their cash and capital ratios. There's this chap who says free to choose. He was one of the people who said the banking system should have 100% cash. Yes, Milton, free to choose outside the banking sector, not inside the banking sector. Oh no, the banking system must do this. All right? All right. And then he's not at all. This was actually, Friedman was actually reflecting a view held widely at the Chicago School in the 1930s, 40s, and 50s, but also this chap, Irving Fisher. Irving Fisher, probably the most important monetary theorist of the first quarter of the 20th century, had a huge influence on Keynes. He thought that the Great Depression of the early 30s was caused by it was caused by a collapse in money growth. They even knew that at the time, actually. It wasn't just Friedman and Schwartz in 1963. They knew that at the time. And he and one or two other people said so. But actually, he wanted a banking system with 100% cash, or at least, and then there's this variant on it, that the banking system is split into two effectively. There's a demand deposit side, money as such, according to some definitions. There must be demand deposits, sight deposits, current accounts. The banks must have 100% cash against these kind of liabilities. And then there's the loan book, which is only against time deposits, deposit accounts, what do you want to call them, where the customers can't draw them straight away, where they have to give notice to actually use them for payments. That is Irving Fisher. He wrote a wonderful book called 100% Money. This was in 1935. There then was another edition in 36, there's another in 1945. And what's wrong with banks is they can create money out of thin air. So he has this wonderful phrase, I think this is going to be in the next presentation by Samuel van Willenmaster. So, the mob rule of thousands of little mints. In the USA at that time, there were thousands of banks. Okay, so anyway, the fewer thousands in 1933 than there were in 1929. Then we actually come on to what Friedman himself said. And Friedman, there's just been a wonderful book by a chap called George Tavlas on the monetarist, which has been reviewed by John Greenwood, who's one of the speakers today. There was, despite various disputes about all this, there certainly was a tradition of thought running through money and banking and so on in Chicago from the 1920s through up to the 1950s. And this influenced Friedman, who had been taught at Chicago in the early 30s. And then he went back there in 1948, I think, 46 or 48. And he was influenced by it, and in 1948 he actually wrote a paper. He was annoyed it wasn't more controversial, but he actually advocated that implicitly banks' assets consist of cash or government securities, just after the Second World War. And when the government runs a budget deficit, when the government is to run a full employment balanced budget, when there's activities beneath full employment, there's going to be a deficit that should be monetized. When the economy is overheating and unemployment is very, very low, then there's going to be strong tax revenues and a surplus. That's then used to withdraw money, and this is to stabilize the economy, keep the quantity of money stable. What then happened over the next 60 years, up until 2007, was that banks' holdings of government securities collapsed relative to total assets. By 2006, UK banks effectively, well, in fact, because I think if you look at the figures, the government securities used in repo, claims on the private sector were more than 100% of assets. I just also advertised Brandon Davis is here and was treasurer of Barclays Bank, and I think had the pleasure of getting rid of many of Barclays gilts at some point in the 1980s, probably, was it? Yes. Anyway, Friedman himself never really wrote anything about how the banks were then evolving through those decades of his life when he was very influential, with assets dominated by claims on the private sector. He never wrote anything about it. And can I just say, by the way, to clarify, I don't like this part of Milton Friedman's work, and I've just written something saying so, all right? Okay. So, now, let me come on to Hayek. All these wonderful, these outstanding thinkers, these people we massively admire. And Hayek's proposal here is just utterly different from the Chicago School. What he wants to do is to end central banks, end the monopoly of the note issue held by the central banks. So there are going to be competing currencies issued by a number of different private sector organizations, completely denationalize the system. This was proposed in a pamphlet called The Denationalization of Money, published by the EIA in the late 1970s. I think it was late 70s, it may have been 1980. I did briefly meet Hayek, courtesy of Ralph Harris. We didn't really get on, but it was. I then did write a critique of this stuff, which then led to a paper in 1981, which then explained how central banking evolves spontaneously. You know, it isn't, and that there is a justification for. Commercial banks want a safe bank where they can they can keep their own cash reserves, and where they can actually possibly borrow. They can have an interbank line. And so the banking system has the demand for a reserve bank, and the ultimate reserve bank is banker to the government, because it's the safest bank. Okay, so there's a rationale for the system we have. Oh no, Hayek didn't like any of this stuff. He didn't reply when I sent him my paper, and they didn't. Okay, fair enough. Then there's Keynes. I'm just going to briefly mention him. He basically wasn't interested in this stuff. He described the system as it was in his 1930 treatise on money, and that was that. And can I just say, I admire him for that. He wasn't going to muck around with the system. Fisher wrote to him asking him to endorse the 100% proposal, and Keynes wasn't interested. So anyway, those are the sort of various. There's a lot more to say. The Tablas book is full of interesting comments on these people, the various people who proposed the 100% cash reserve idea. What I'm going to just summarize in all this is that if you don't mind, these people are in a mess. I mean, you know, they're polar opposites, all right? Chicago School is essentially, more or less, wants to take banking back to where it started, because banking begins the realization that you don't need to have 100% cash against your liabilities, really. And you have, you know, this a chap called Phillips wrote a book, wonderful book, 1920s, Bank Critics, is a banker, not an economist, and he said basically banking is about reducing increasing the balance sheet relative to both your capital and your cash, getting those assets on to produce the profits, and then there's competition to get the cost of the facilities down to. Oh, I'm way ahead. I'm not going to finish off on this. I better go through this quickly now. Okay. I'm now going to give two defenses of the banking system that we have. Okay, two key ones. One is about the spread. It's simple algebra. The spread on bank loans. Okay, I'm not going to go through this now. It's just very simple algebra. Then you see we get an expression for this, and essentially the spread that banks must charge on their assets, on their loans, to deliver a given target rate of return on capital is lower the more leverage they have and the more fractional reserving they have. Okay? So the cost of those facilities you get from banks, that spread, S here, is reduced by the amount of increase in the risk in the system because of the leveraging and the fractional reserving. Okay? And then what this means, and then this is something I teach at start of banking. There's all those money lenders out there charging 20-30% on their loans. In the heyday of the euro markets, which you'll remember these actually, Brandon. You know, the banks would be charging 20, 30, 40 pips over interbank, and still hoping to make a decent return on capital because the ratios were incredibly low. Okay, that was not like that now, I gather, but anyway. So effectively, the more leveraged the system is, the more fractionally reserved it is, the lower the cost of its facilities, which then means you don't really need to bother about all this, but it's the more capital intensive production is, because the banks, you know, they're charging hardly anything, so there's more projects make sense, okay? The banks have got wafer thin margins, so that these projects make sense with them. And then the more capital labor that there is, more machinery and so on, the higher living standards. So the banking system with leverage and fractional reserving improves living standards. And if you reverse that process, it's not been going on since 2008, you will reduce living standards and the rate of growth of the economy because the economy will be less capital intensive. All right? There is another benefit from the banking system, and this I'm going to be a bit cryptic about, which is that essentially there are two kinds of banks. One bank can create money from scratch, another can't. I'm not going to go in detail. those banks that can create money from scratch can give overdraft facilities. Can I just say, in the real world, banks that depend upon deposit inflows to grow their assets, they don't give overdraft facilities. That's true in the real world. Non-bank customers want those overdraft facilities because they are by far the most flexible, low-cost form of finance, unless the bank charges very highly for the overdraft facilities. The charge for the overdrafts reflects the fact that the banks that provide them have invested in the settlement business. Okay, so what I've done today is highlighted this division between different types of free market economies, and the subject basically is just a dreadful mess. This hasn't been sorted out in free market economics at all. Defended what we have, and then I can shut up but I just want to finish off by saying that in my view this is important to the future of market capitalism, because the financial sector is a distinctive part of capitalism. There are private property rights. That then means that's vital to the fact that power is dispersed in these societies. These aren't tyrannical societies. They're free to do things, free to choose. Private property. Then private property, you can buy and sell private property. You can lend it. You can borrow it. You can use it as collateral. And all these things depend in part on the lawyers and the financial system. And to the extent that the financial system is being attacked and is in retreat, then so are the institutions of a capitalist free market economy. My blinding insight was a very simple one, which is that the 100% cash reserve proposal could well come in through the back door, through commercial banks being told, we, the central bank, will in future be the settlement bank. You're not supposed to get involved in this business. That's effectively a 100% cash reserve system, because it's central bank digital currency. We all have our accounts with the central bank. We don't have our payment accounts anymore with commercial banks. And the commercial banks are then separate. They can offer interest on their deposits. The question of how money switches between those commercial bank deposits and the central bank deposits, I don't really know. That's for discussion. But actually, the commercial banks don't really have, may have a trivial account that the central bank carry out these transfers, but actually the bulk of their assets will be loan books. And commercial banks will effectively become what in some countries has been called industrial banks, which don't really offer settlement services to the non-bank public. I can well see that as being proposed and emerging in the next 10 or 20 years. Can I just say, I think like many people here, I'm deeply suspicious and hostile to the very suggestion that but that seems to me like could well happen in China. That sort of pattern could well evolve. So there is a link between these different parts of what we're talking about today. Okay, thank you.